Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seamer interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seamer.
Welcome everybody back to another episode of the Apartment Guys podcast. Today we've got a fun guest in the house, and we're not just the Apartment Guys today. Again, we're the Apartment Guys and Gals, and we love going into that mode. I love talking to my women colleague friends that are killing it in real estate. And it's a real pleasure to have Brianna Schmidt on the show today with me. Bree acquired her first investment property in 2011 and left the corporate world just 3 years later in 2014 and became a full-time real estate investor. She's now the managing broker of Second City Real Estate, a full-service brokerage firm in the Windy City, I'm assuming, based on the Second City name. A full service brokerage working with new investors and seasoned investors looking to expand their knowledge of the industry and their portfolio as well. Bree uses her extensive knowledge of building and managing a portfolio to teach clients all about aspects of buy and hold investing, which is where it is at. We talk about it all the time on the show, buy and hold. Bree teaches you how to analyze potential properties, how to calculate your ROI, best practices when marketing and leasing your rental property, and how to be a landlord and build a portfolio. Bree's job does not end when you close on a property. She's always available to help you throughout the process and scale your business. So she's strategy focused and will help you in your holistic approach to your business. Bree is also the co-founder of the Midwest Real Estate Networking Summit, a weekend educational summit for real estate investors. This event provides new to experienced investors with the tools and connections necessary to build a real estate business. Bree's other passion is travel, and check this out, guys. The past few years, she has been to, in alphabetical order, I noticed, Albania, Costa Rica, Croatia, Colombia, England, France, Germany, Greece, Ireland, Italy, Macedonia, Morocco, Portugal, Scotland, Serbia, Spain, Sweden, the Netherlands, and Thailand. Just in the last few years, Bree?
Yeah. So we were talking about it before the show.
Yeah.
About how, I left corporate in 2014 to be a full-time real estate investor, thinking that I had financial freedom to do what I want. And the business really, I don't want to say it ate me alive, but, a few years went by and I realized I was working more hours doing real estate than I was in corporate. And that's not what that was not my intention moving forward. So I spent the last few years really, digging into systems, processes, efficiencies. And our goal, we try to take off about 2 months a year to travel. So I actually took off, even with COVID, we took off 4 months last year.
Wow.
And just, set the business up to run itself. And, the purpose is to enjoy life, right?
Right. Yeah. And that's financial freedom right there, is having cash flowing assets that in this case are your brokerage and your business and your properties, right? That are producing enough passive cash flow to support you, whether you're working in the business or not, whether you're present in the business or not, whether you're in Morocco, Macedonia, et cetera, Serbia, or you're in Chicago and you're behind your desk. That business is cranking no matter what. So let's start now. I love, we did talk a little bit before we started recording, and we talked a little bit about kind of your lifestyle design that you were just alluding to. And not only are you taking 2 months off, at least maybe 4 last year, but you also keep it to a 30-hour work week, which a lot of us in real estate would be amazed by. I'm amazed by that. And find that hard hard to imagine right now, at least in the trajectory of our business and where we are. But talk a little bit about the intentions that the intentionality that you had to approach this all with, to set things up in such a way that serves you so well.
Yeah, so my story is somewhat interesting. I started investing in 2011, bought a 3-unit property. We house hacked, which is a term people use. We use an FHA loan. We lived in one unit, rented out the other units. And really that was the end of the intention. We're like, cool, we can have, tenants pay part of our mortgage. And then eventually we need more space. We'll just, move some walls, and we've got 2 floors. And then eventually we'll need more space and move some walls. We got 3 floors, and now we'll have a single family house in like 10 years. And that was the end game of all of it.
Mm-hmm.
About a year after we bought our first property, my father passed away. So he had a very aggressive form of cancer. He passed away literally the day before he was supposed to retire.
Oh, wow.
So, he'd always said, when I retire, I'm going to go do this. And when I retire, I'm going to go do that. And, it was we had like a 9-month time period from diagnosis to passing away. And it really sunk in with me. I was, I think, 28 years old, and I just gotten married and was like, well, crap, I've been working in corporate for the last 9 years, building this career, which I loved. But am I going to be like that? Like, I've got 30 more years to go before retirement, and I traveled a lot for business, and I worked 60-hour work weeks. I'm like, is this going to be the next 30 years of my life? Like, I'm not going to be able to survive that mentally. This is not what I want. So how to really reconsider life in general. And that's when we started getting more aggressive with real estate investing. So that was in 2012. Started ramping up my portfolio, buying more properties. And then in 2014 is when I quit my job to do real estate full time. But it really wasn't until 2017 that, like I said, I ended up working, more hours than I worked in corporate. In 2017 is when I started reading a lot more about intentions, processes, understanding like, what do I need to do now so that I can actually have the life that I set out to have.
Yeah, that's awesome. So you made some decisions right around that 2017 time frame and started to get intentional about really designing your business and your life in such a way that serves you well, that is a life that you love to live, right? Like 2 months off a year, 3 months off, 4 months off a year is something that so many of us dream of having. And to have that, and to have your normal work week be so nicely structured as well, is quite significant and something to be commended.
Yeah, I mean, it depends, said like the last month I maybe worked 20 hours a week. The last 10 days I've been working like 60 hours a week. So it's, that's one of the downfalls of our business, is
Right.
it's not really controllable. It's a very reactionary business. I said, I've got, the brokerage firm. I have 10 agents that work for me, as well as I'm an agent myself. We could have no properties come on the market, but then last week I had 3 listings come up. So, you gotta work with it. Same in the rental business, if tenants pay rent and there's no problems, then that's what the manager's for. But when tenants move in the middle of the night and damage the unit, like, now you've got to be involved. Or a furnace goes out, and when one furnace goes out, like 3 go out. I don't know why, and they never go out like business hours. They always go out like Sunday morning when the repair place is closed. Like, that's just the nature of the business. So it's very reactionary. But what I've learned about really is priorities, right? What in my business makes me money. So that's what I should be spending my time on. And also, what do I enjoy doing? So people always, joke with me, like, I do all my accounting, but I've got 7 LLCs. I've got 14 bank accounts. And I love doing accounting.
Wow.
Every 2 weeks I do the books. I'm like, I could easily outsource that. That is a task that can be outsourced, no problem. But for me, like, A, I like doing it. And B, because I have staff that manages my properties for me, it keeps me up to date with what's going on. So when I actually like, I go through, I put it all in my own accounting system, that then like I then know things, so when, they're replacing a washer, I'm like, didn't we just do that 3 months ago? Like I have that sort of memory. It keeps me on top of the business. So like that's something that I prioritize to do. I have to do it every 2 weeks. Because if you wait a month to do it, then it becomes a huge task that you just don't want to do and you'll procrastinate on. So that's another part of it is I break things up in really small tasks so that they're manageable and easy to do. That way I don't get overwhelmed and stressed out that I have a major to-do list. But everything that I hate doing or everything that I'm not good at doing, I outsource.
So smart. That's we talk about knowing your superpower a lot on the podcast, and you kind of define that, like knowing what you're good at, what you like doing, and what's important to the business, obviously. And you can create a tremendous amount of value by essentially being your own accountant. And in your case, you're at that point, you're CFO and you're CPA and just about everything else as far as, keeping track of the books and keeping an eye on the business from that side of things is very hands-on for a lot of people. But if you like doing it, and that means you're going to be good at doing it generally, if you like doing it, and therefore you're going to have a pretty high impact on your business.
Yeah. So what I did is that about 4 years ago is when I started this process, when I was getting a little too overwhelmed. So every day before I went to bed, I wrote down what I spent my day doing. I spent 2 hours on accounting. I spent 3 hours on marketing or whatever. And then I kind of tallied it up at the end of the week and was like, oh, I put it in Excel because I'm an Excel psycho. Then I was like, I suck at marketing. Like it takes me, I'm so not creative. I'm just a numbers person. It takes me so long to create a crappy postcard or something like that when I could hire it off on Fiverr. So that was one of the things that like I realized like, hey, I'm spending like 10 hours a week on marketing, but I hate it. I dread having to do it and I'm not very good at it. How can I outsource this? And so I just kept doing that week after week. I kept refining my list and looking at, okay, now I'm spending way too much time doing this task. How can I because I actually like that task. How can I, streamline it, right? Or work something out or be better at it so I can do it faster. And I just kept doing that week after week after week and just kind of refining my list. And after about a month, I really kind of had it down pat that like, hey, these are the things that I like to do and that make me money that I need to do to run my business, not like a professional. And these are the things that I can just hire out and have someone else do. And, another thing, like I don't do in-person meetings. I'm a girl, you're a guy. Guys, you don't need to brush your hair or put on makeup. Like this whole thing takes like at least 30 minutes, and then like, so then I've got to find the outfit and do my hair and do my makeup. Then I've got to drive an hour to a meeting, and then drive an hour, like that's 3 hours of my life for a 30-minute meeting that could have been a phone call. So now I just don't do in-person meetings. I only do phone calls. And then I can stack them back to back. Now I'm being more efficient in my process. Those kind of things are all just, part of the learning experience.
Yeah, you're setting rules, setting boundaries, standard operating procedures, and doing it in such a way that confines your production, your capacity of your bandwidth. Really, you're saving your bandwidth. So my dog Joey's chiming in. He loves when we do the podcast. So
you'll hear my toddler later, I'm sure.
So
that's our new life, right?
Yeah, that's it.
Like you just gotta go with it. This is our new normal.
This is not the first time he's chimed in on a podcast, but it's all good. It's all good. So cool. So talk about kind of a big picture strategy for you in terms of what you're building. You got a successful brokerage, 10 agents. You do have a rental portfolio at this point still, don't you? I know you sold some properties last year.
Yeah. So that's also so I went a little crazy. I bought a property in 2013. I bought a property or 2011, 2012, 2013. 14, I bought 10 properties. 2015, I bought another 8 for myself. And then I started taking on partners and bought another 10 properties that year. So it was a very aggressive, crazy couple of years. And then, 2016 was really about, stabilization, right? Optimization, what improvements can we make on these properties to get market rents? We had a great manager in place. So it was really just a year learning experience on that. And then, I started selling in 2019. And it was really interesting. I was at a conference in Philadelphia, and the first speaker of the morning was an economist. And he started using a lot of big words that I did not understand, and how real estate is tied into equities and, yield curve, and just went way over my head. I was writing down all these things, like I should Google this later. Because while I understand the real estate market, I do not understand the greater economic market and how those things impact each other. So interestingly enough, at the end of the conference, they did a auction, right? You can auction, a weekend in Vegas or things that people had donated to raise money for charity. Well, this economist auctioned his time, 3 hours of his time. So I bid on him for his time and had meetings with him. So it was a really interesting, he helped me understand some things, but part of that process was he wanted to do a deep dive in my portfolio. So we went back in the last 5 years of data, all of our rents, CapEx, projections, all this stuff. And he really put me in a position, like when you're in the business and you have property, and you're seeing it month to month, right? It looks good. You might have some bumps here and there. You might have a bad month, but good months. But it wasn't until I looked back at the last 5 years of my portfolio as a whole that I really got a much different perspective of it. So part of that exercise was looking at what we bought it for, what our annual cash flow was, what we would sell it for, all those stuff. And he broke down a bunch of numbers for me and looked at it and was like, well, there's a couple of properties that haven't been the greatest cash flow. While they're okay, but if I sold them, I would get 15 years of cash flow up front. So like, what's my trigger point for selling? So I decided my trigger point was 10 years. So for me, like if I can get 10 years cash flow up front, I'm going to sell it right now. And that's what I did. So I sold 14 properties, and from summer 2019 until spring 2020, we had like our last ones were under contract right before COVID. So they closed in like the few weeks after the whole COVID thing started. But that was part of the exercise, was like, well, if I can do better things with that money, if I sell it and then parlay it into something else. What that is right now, I do not know. I still have not decided. Nothing has really spoken to me. But that was kind of the exercise that we did. And it was very beneficial. So now every year I review my portfolio at the 1 year previous cash flow, the 3 year previous cash flow. And then I look at, since the inception of the property, what my cash flow is, and kind of reevaluate my portfolio every year.
So smart. You can't improve what you can't measure, right? There's some clever way of saying that. You can't manage what you can't measure, or you can only measure you can only manage what you can measure, I think is maybe but that's so important. You're taking the 30,000 foot view of your whole portfolio, and you had some help in doing that and kind of getting a second pair of eyes on it. That's super exciting. So
yeah, perfect example of, I don't know, I'm not smart enough to know these things. So that was a situation where, again, I hired it out, someone else to teach me. But there was a really big wake up call for me. A lot of the properties I thought like, yeah, they're doing great, and it wasn't. It's like when you look back at it and look at it holistically, it was no brainer to sell them. It really was a no brainer.
Were these mostly single family? You say you do a lot of two to four units. So these are duplexes, triplexes, fourplexes.
I invest in the Chicago and Milwaukee market. So those markets are a little bit unique in terms of housing stock, where in the city markets, any general neighborhoods will be anywhere from 50 to 70% 2 to 4 unit properties. So they're dense urban environments, and there's a large surplus of 2 to 4 unit properties. And those are the markets that I tend to invest in.
Okay. So what's a typical property look like in terms of the economics and the vintage and the amount of work needed and that sort of thing?
It depends. So, you know, the wholly owned portfolio. So I don't have, while I had partners, we sold off the majority of our portfolio.
Hmm.
So everything has been my own money.
Hmm.
So it's a different perspective on things.
Yeah.
Because always give the example as I was buying a duplex in Milwaukee. This was back when the market was a lot cheaper. But I was buying a duplex for I think $35,000. It needed $20,000 of work.
Hmm.
And then I could rent out each unit for I think $750. Right. It's like on paper, that sounds awesome,
That
right?
is awesome. Yeah.
I passed on it, and I passed on
Mhm.
it because that $20,000 of work that was needed on it was actually $100,000 of house I couldn't buy in the future,
Mm,
right? So I could
right.
buy two duplexes at 50 grand each
Yep.
with that same cash outlay
Yep.
and get double the return that I was getting by putting 20 grand into this one. So understanding like where your cash is best put to use, I think is a really important part, especially when you're investing on your own. And it's, I don't have an infinite number of amount of cash. I have a
Right.
finite number to spend. So like what's the best I can get? So I tend to go for properties that don't need a ton of work
Hmm.
or that need, minor improvements. But we said we bought, with my own portfolio, just myself, I bought 18 properties in 9 months and it was 67 units. That is a lot for one person to take on. So we, try to keep tenants that were in place and then just rehab as we went, as tenants vacated.
We're doing that right now in a 20-unit building here in Utah, and we're also planning on doing that in 249 units in Columbus, Ohio area as we get into our new acquisitions. But basically, you're talking about organic rent or I'm sorry, organic turnover, right?
Yeah.
As leases expire, people move out, and you have an opportunity to improve the property at that point. At a point in time that is convenient to you and to the outgoing tenant and the incoming tenant. It makes an awful lot of sense because of the exponential. Whether it's 2 units, 4 units, or 40 units, or 400 units, if you're increasing the income, the NOI of a property, you're increasing the value exponentially.
Yeah.
And it's a little different with 2 to 4 units because they're not technically commercial, considered
They're
small
valued
commercial
differently. Yeah.
asset, so they're evaluated a little differently. 2 to 4 units, for the listener, you may know this, but 2 to 4 units are typically evaluated based on comparable properties that have sold in the area in recent time, and basically those values are established by the buyer and the seller of those properties and the appraisers, right? So with commercial properties, one of the things that a lot of people really like about commercial properties when you get to 5 units or more is that the valuation is based 100% on the income of the property, and a formulation that has to do with a capitalization rate. That's a deeper dive than we're going to take today, but basically they're two different forms of valuation. That said, when you increase the income on a 2 unit, 3 unit, 4 unit, the desirability of that goes up, and it's going to comp higher against existing comps than it would otherwise if the income was lower. Would you agree with that, Bree?
Yeah, it's as I said, I have got, so my Milwaukee portfolio, while it's residential assets, meaning under 5 units,
Yeah.
it's got commercial loans on it.
Oh,
So
wow.
it's a really interesting, because I had to still meet cap rate and DSCR requirements for the
Okay.
loan. But then it's still to be valued, it had to be appraised both ways and still meet the bank's commercial criteria as well as the residential criteria. Yeah, it's a different world. So with commercial, it's much easier. It's a much easier math problem, right?
Mm-hmm.
It's very simple. increase rents, decrease expenses, you increase the value.
Mm-hmm.
With residential, it's definitely a lot more fluid. You have also have opportunity for market appreciation,
Right.
More in residential. So it's been fun either way. But yeah, it's,
Yeah. And you have some agents in your brokerage that work in the multifamily space. Is that correct?
Yeah, and as do I.
Yeah.
Yeah,
And
because
so
it
do you.
depends on the housing stock, really, of the market.
Mm-hmm.
Even like I said, Chicago market, the north side where I work, a value add 12 unit, you're looking at a $3 million purchase point,
Mm-hmm.
And probably $600,000 to $800,000 in renovation costs. And then you're still at the end of the day getting like a 5.5 cap.
Mm-hmm.
So it's not really a strong multifamily market here in the city. And again, we don't also have a lot of housing stock of larger buildings.
Right.
Suburban markets, yeah. There's a lot more, those really nice. They've got the gym and the Wi-Fi and the pool and the little lake that you can go to.
Yeah.
We don't have that stuff in the city.
Yeah.
So it just really depends on the market and what is going to generate you the best opportunity.
Mm-hmm. Right. Yeah. And these large, like you said, these larger assets don't exist everywhere. And so the opportunity is not always there in your immediate market, which is why we're in Salt Lake City, and we've got a lot of when you were describing the Chicago ecosystem right now and kind of the environment, what's going on there, it reminded me a lot of what's happening in Salt Lake City, where you're into units 250,000 a unit, 300,000 a unit, whatever. And you're getting good rents, but you're certainly talking about a 5 cap, if that, right? Maybe high fours, mid to high fours. We even had a sub 4 cap sale just this last year on a Class A asset here in Salt Lake City. So we spend a lot of time in Oklahoma City and Columbus, Ohio, and Tulsa, those 3 markets in particular, because we can pick units up for 40, 50,000 a unit that rent for $600, $650, $700 a month, which is, beat your 1% rule, which is, one metric that people use. If you've got 1% of your purchase price coming in the way of income per unit, per month, then that's generally considered to be a pencilable deal or a good deal. So if you're paying 50,000 a month or 50,000 a unit for a place, and you can rent it for 500 a month or more, that's the 1% rule. So, and
can I interject?
Yeah, please do.
I hate that rule.
Yeah,
I hate it. I think it's the worst.
Well, it's such a thumbnail sketch, but yes, please say why.
Because it provides no actual information. So 1% rule on an A or B class, fine, because your expense ratios aren't going to be that high. But a 1% rule on a C class asset, like, you're screwed. People do not understand when you're dealing with $500, $600, $700 rents. You got to think about your tenant class. I always like to explain it like my Milwaukee portfolio is C class. My tenants, if their car breaks down and it's going to cost $400 to fix it, they don't have that money to do so. So now they can't go to work for a week, and now they're behind on rent. And the eviction system is like super landlord friendly in Milwaukee market, and it's all through an online database. So once you file for eviction in Milwaukee, anyone can see it. So as soon as you're about to file, they just move. They just move out in the middle of the night, because that's better for them. They don't want to be in the system as having an eviction. And so you'll have, like, I'll get emails from the, happens a couple times a year, from the energy company, like, FYI, they turned off your service. I've got to call my manager, like, we just talked to them 2 days ago, and then they just move. So expenses in C-class assets, you're looking at least 50 to 60%.
Yeah.
So if you're just basing it off of the 1% rule, like, you have to take the market factors into consideration before judging based on just that. Yeah, it's a BP thing. It drives me crazy. I ranted on it like a million times over the last 10 years. And that's my little spiel rant. Sorry.
No, it's great. It's really good perspective. And it's a reminder that there are tons of levers and variables in these deals, and your expense ratio is a big metric. Obviously,
Yeah.
it's a huge deal, and you're right. In a Class C asset, we are generally finding that right around 50% is where
Mhm.
our underwriting comes in. Typically, sometimes mid 50s, 57-ish%, especially when you're talking about existing financials. When you're talking about what's actually coming in, what's actually going out, and what it's actually costing to run the place versus maybe what you think you can get for it, like a pro forma financial. It can really be that expense ratio can really be quite high. So you're absolutely right. That said, when you're talking about a 50 unit, 100 unit type deal, there are only so many ways to really get your head around whether or not it's a deal without breaking into a spreadsheet.
Oh, for sure.
At first glance, right? So it's just, if an asset is shattering the 1% rule, like in other words, if we can pick something up for 50,000 and it's renting for 850 or something like that, 900, that's a really positive thing that points to maybe this deal deserves more attention. But if it's real close to the 1%, it's probably, unless there's a real big upside and a value add lift available, it's going to be a tougher deal to get to work.
Yeah.
That's all. Yeah.
And there's a lot of factors to consider in all this. Market class, one of the questions I get all the time is, because I do 2 to 4 units. So, should I invest in 2 to 4 units? I'm like, it depends on the market. There's very few markets that have the dense urban environment where an A, B type tenant will rent a 2 to 4 unit property. Like in the suburban markets here in Chicago, I would not recommend buying 2 to 4 unit properties because you're going to get, the quality tenants are going to rent single family houses. If they can't afford single family, they're going to rent a townhouse, or then they're going to go to one of the big communities with the pool and the lake and the gym. But then, like, if they can't afford all of that, now they're looking at these small 2 to 4 unit properties. So you're almost always going to get C class tenants, even in a nicer area. So did you really got to learn your market and what that market will deliver for you?
What do your typical rents look like in your assets?
Chicago market between 15 and 1800.
Wow.
Milwaukee market between 7 and 900.
So almost 100% difference between the two. That's pretty amazing. That speaks to, I think, to the phenomenon that Chicago is.
Chicago's also a very expensive market.
Yeah.
Like, no investor calls me and says, I'm from out of state, I want to invest in the Chicago market.
Right.
Because the returns that I can provide you are just not going to be reasonable. They're not going to be something that you want to look at.
Yeah.
Suburban markets, yes, we have a lot of our out of state investors do more of the suburban markets or the south side of Chicago. But with the north side where I work, it's just not a thing for other investors.
Mm-hmm. What are most investors, when you get a call, what's a typical investor call go like?
They're from California,
right?
They typically work what?
They have cash.
They have cash.
Yeah.
For some reason, they work in engineering. I don't know why, but that's a thing. It's always like California engineering, looking for diversification. But really, in those kind of markets, especially with California, gosh, if you can find a 4 cap in California, like you've hit a home run. So they're looking for, other options. Again, it depends on the market. So in Chicago, we are low 6s for 2 to 4 unit properties. Sometimes we get like a 6.25%, 6.5% cap rate. But that's really like the best it's going to get in our market. So once I usually tell them that, they're not very interested. And then I point them to my other agents who do other properties where you can get closer to like a 7 or an 8.
What can you get what can you get in your markets for a 7 or an 8?
You can get like a 20 unit for, let's say, 2.5. In a nice working class neighborhood. So not something that you would want to come in and do, quartz and shaker cabinets. Right. But something that you would come in and put, probably maybe some like repaint the cabinets and do laminate, do like LVP flooring sort of thing. And then get, solid rents, like 2 bedrooms around maybe 1,000, 1,100.
Yeah. I mean, that's not a bad deal right there.
No, it's not.
I mean, those numbers are not
But
unlike numbers that we see every day.
we don't have a lot of just other housing stock.
Yeah.
We really like the multifamily market in Chicago is primarily going to be 20 to 50 units. There's really not much more. There's only a few communities that are like over 50 units, and a lot of multifamily. You guys like to go big or go home, right? I love the investors that tell me, I'm looking to buy my first investment and I want at least 200 units.
Yeah, right.
So that's like the starting point for you guys. I don't know why. So yeah, it would be a lot smaller assets though.
Yeah. Yeah, we just put a 51 unit under contract this morning. So we're definitely open to smaller assets, but this one made a lot of sense because of a sister asset that's right next to it, that's owned by a friend and a colleague, and we're going to co-brand and co-manage. And so,
that should be fun.
There's different reasons why. And one thing for the listener to kind of keep in mind when we talk about scalability and economies of scale and how exciting leverage is when you move up into 100 units, 150 units, 200 units. The issue with that is with that size asset is typically you're getting into a less desirable a more desirable asset through the scale of the asset, right? So you're going to end up with a lot more competition from bigger money sources, coastal money, institutional money, California money, whatever you want to call it, wherever it's coming from, that wants to gobble up the 200 plus unit, like Bree was just saying, that is kind of a magic number. And that said, it opens up an opportunity in that 40 to 150 unit type asset. And so there's less competition in those smaller asset classes. And of course you go smaller than 40 even then, and this is even more so the case. You're not going to end up competing against a REIT for a 25 unit in Milwaukee, for instance. You're going to compete against probably maybe a mom and pop or boutique kind of investment firm. So it's a different game and it's more accessible, but the trade-off is that you lose some economies of scale. And it's just finding that balance and, figuring out how to make it all profitable and how to make it all work.
That's actually a really important point. So scale. I always found it funny that, said mine are all under $1 million houses. So in the commercial world, I have to give a personal guarantee, but you guys can buy $5 million on your first buy and not have a personal guarantee. So the more money you buy in commercial, the less liability you have, which I always found to be really funny. But scale is incredibly important. So when I built my portfolios, my Chicago properties are all within 5 miles of each other. My Milwaukee properties are all within 5 miles of each other. So having that scale is incredibly important. Like you said, if you're going to buy, a 20 unit here and then a 20 unit there, it's harder to manage. And having that scale is going to get you lower pricing with your property management. You can afford, if you've got bigger properties, you can afford on-site property management. Versus a 20 unit, you're not really going to have an on-site manager probably. And then, so with our portfolio, we're a priority to our property manager. I have just under 100 units with him. So when I call him and say, hey, I need you to stop what you're doing and I need this taken care of today, you better believe that I get taken care of. Versus if you just have a duplex, right? And you call him, like you're just not a priority. So understanding scale, it's a really big component and decision factor to take into account for sure.
Yeah. Let's say you own a $300,000 1,500 square foot house and you want to rent it out, and you call a a big time property manager in town, they're not even going to take your call on something like that. But let's say that $300,000 dollar house is part of a 40 unit portfolio, or with duplexes and fourplexes and that sort of thing. All of a sudden that gets you into a category of property management that you want. Like, you need to have that, especially at that scale. And all the gurus in this business will tell you that self-management is not where you want to spend your time. It's not profitable activity, generally speaking. And so really leveraging your property manager well, and having great systems and processes around your interaction, your management of your property manager is incredibly important in this business as well. Can you speak to a little bit about how you've nurtured your property managers relationships and kind of how that's all gone?
It's a fun story. So I said, like, I have, my Milwaukee portfolio is quite large. So I self-managed the first year that we did it. I live in Chicago, so it's an hour and a half drive one way. I had hired my own in-house property manager that was training to do things the way that I wanted them done. After a year though, when I started taking on my partners, and then I was not dealing with my own money, I was dealing with other people's money at that point, took on a whole new level of responsibility. And while he was really good at half the job, he was also not very good at the other half of the job. So tenants paid cash. He would go deposit like 10 G's into my account. And then I'd ask, well, who's this for? And then he's like, I got the receipts in my pocket, and like, he would just write down like who paid what. And I would have to go up there and then take the receipts from his pocket and then put them into an Excel or, a software to see, well, so-and-so hasn't paid rent for 2 months. And he's just like, oh, I didn't know that. I'm like, because you're not tracking anything. So when we went to go hire property managers, we decided to split our portfolio into two, figuring, hey, I've got, one guy to pin against the other guy. And if one guy screws up, I'm only risking half the portfolio. So the one guy screwed up pretty immediately. It really sucked. And they ended up going out of business within 3 months of us leaving because I pointed out so many issues with their business. So then we all went back to the one property manager for a while. And then that was good for a few years. They started to get overwhelmed. Things started falling through the cracks. So I decided to take away half the portfolio again to another manager who was equally sucky. And then went back to the original property manager again for everything. So now it's been a few years. In the beginning, I used to go up there once a month, and they give me the reports. I'd write my list of questions, and we would sit down and go through everything. After about a year and a half of doing that though, you learn shorthand, so like now at this point, I haven't been there in 3 years. We email, they send me the report. I go through it. I email my questions. They respond. If we need to have a phone conversation, we do. Typically, maybe once or twice a year, it's needed. But they don't also said they know me and what I'm going to say. So there's certain aspects of property management that so if a furnace goes out, it's going to go out on a Sunday morning when the place is closed. It never goes out Monday at 8 o'clock in the morning when the place is just opening up. But why are you calling me and telling me that the furnace is out? It's winter. It needs to get fixed. There's no point of bothering me with that sort of thing when I really have no choice in the matter. Right. Now, if it's a matter of the furnace is 12 years old and it needs a blower, which is going to cost $500, or it's going to go out in a few years anyways, do we replace it for $1,200? Right? That's a conversation I want to be involved in. But outside of that, I really don't. They should be able to run their business. I fully believe in hiring people who are competent. So if I need to micromanage you and tell you how to do your job, you shouldn't be working for me. Simple as that. Yeah. I should have enough respect for you and that you can run it intelligently. I should be able to do checks and balances, right, until you become comfortable. But if you're having to double check your property manager, or there's lots of questions about, well, why was this charged? Or, then you need to find a new property manager.
Words of wisdom to take heed for sure. We're entering
the property manager will, the property manager could turn you from a 4 cap to a 7 cap, or vice versa. Take your 7 cap on paper and make it a 4 cap.
Right. Yeah. Yeah. It is the key cog in the wheel in this whole business is your property management. We talk about how self-management is not time well spent. Part of that is because it takes a really experienced pro to manage property well, especially at scale. So, Bree's got all of her properties in Milwaukee that she needs to have managed as one portfolio, as a chunk of properties. And so you've gone and found the best.
We talked about it in the beginning, understanding what you're good at and what your time is best spent doing, right? With property management, there's a lot of different skill sets. Someone's got to run the books, right? Someone's got to run the invoicing and make sure that any GCs or whatever are paid. Someone's got to deal with tenant relations. Someone's got to deal with rent collection. Like, someone's got to manage the repair guys. Like, there's too many skill sets for one person to manage successfully.
Yeah.
It's simple as that. You can do part of the business well, but I've never met one person who can do all aspects of that business well.
Yeah, that's awesome. Well, I love to, I kind of geek out on a few little questions, like finishing questions
Sure.
and I want to ask you, I'm going to steal a question from my buddy Ruben Grath, who has a podcast that I love. And just because of all the places you've been in the world, what is your favorite vacation ever?
Ooh. The favorite place I've been, or favorite vacation?
Well, let's say favorite place you've been.
Okay. My favorite country overall is Spain.
Okay.
I've been to Spain a few times. I've been to, I think, 6 or 7 cities in Spain. Spain is just chill. Spain is the opposite of America, right? They nap in the middle of the day. Everyone just like strolls around. No one's got anywhere to be. When you go to lunch in Spain, it's like an hour and a half, 2-hour lunch. Like, eating and then getting the bill is not a thing. So it's just such an opposite, like, chill, relaxed lifestyle that, like, I really enjoy going to Spain.
That's awesome. I haven't been there. I'll put it on the top of my list. I have a big Europe trip in front of me anyway, so that's coming.
Oh, cool.
Coming my way soon. Yeah, I need to get there. Okay, so let's say we had a magic wand and we could wave it, and in 3 years things have gone as well as they possibly could have, or even better for you and your business and your portfolio, for that matter, your investment portfolio. What do things look like at that point?
It's a funny question. So I don't set goals.
Okay.
Which is the opposite of what most people suggest. Said I feel everything in my life. So when I quit my job in 2016, my job was going to be to run the Milwaukee portfolio. That's what I was going to do. That year, I started a website business, and then I started my brokerage business. And then about a year and a half later, I started the Midwest Real Estate Networking Summit. It's like all these things that happened just happened because it seemed right, and I was excited about it. So I don't want to set goals on myself of, hey, I want to get to X number of units, because if I'm buying shitty units just to get to a goal, right, I'm going to shoot myself in the foot, because you bend the numbers. People always do that. I call it square peg, round hole syndrome. I want to buy 200 units this year. Well, then they start kind of like bending the numbers to make it work in their head so that they can reach their goal. So I don't have goals. I just kind of let life take me where it's going to take me, and the right opportunity will present itself and make sense to me, and then I'll go for it.
It sounds like you kind of follow, in the words of Joseph Campbell, you kind of follow your bliss a little bit. You let your passion and your interests and what's really making you tick at the time kind of guide your decisions.
Absolutely. I mean, work sucks if you don't love it, right? For the last few years, I've been able to wake up every day and love what I do. So it's not work to me. I don't hate any aspect of my job or jobs, they're plural. It's because I do what I love to do. And when I don't like to do it anymore, I then don't do it anymore. I'll sell it off or figure something else out, right? But that's what this whole lifestyle is about, is figuring out, what's your bliss, what's your passion, and then really focusing on that.
Yeah. And the bet there is, it's not really even a bet because we all know how it works, that by doing so, you're going to be the most successful in that lane because it is your passion, because you love it, because it drives you, because it pulls you out of bed in the morning. That's the idea right there. And
Yeah.
I think those of us that are lucky enough to have locked into that, it truly is blissful. Like there really is a joy behind being locked into your purpose and
For sure.
and kind of engaged and intuitively in what you're up to. That's super powerful. So how about just two last questions here to kind of round things out. How about mentors, authors, important thought leaders that have kind of been informative to you along your way, either personally or professionally?
There's a lot, really. I think that's one of the things I love about real estate investors. For us, it's not a job, it's a lifestyle choice. And one of the things I really appreciate is part of that process is always learning. So always reading, we're always reading article, even if it's a blog. We can always get new things from that. So that's why I read a lot more blogs than anything than books. So I've got a toddler at home. So, time to sit down and read is not a 300-page book is just not feasible in my life. So yeah, I said I should just subscribe to a lot of blogs and read people's opinions. You can always learn something new from people of different experiences than you. So even like the whole mobile home park world. Like I like reading about that because that's something that's totally different than what I do. And some of the things that they're doing there, I could learn and then implement in my business.
Yeah, that the mobile home park world is a very much an emerging kind of asset class that, or at least in terms of people's awareness and like consciousness of how good an asset class it is. We had a mobile park home maven on the show recently, talking about mobile home parks and how exciting they are, and they are very similar in a lot of ways to multifamily and real estate in general. It's all about income and appreciation and tax advantages. We haven't even talked about tax advantages today at all, which are massive. Both in the multifamily space and in the residential asset class space as well. But we're
you sell.
Right. Exactly. Yeah.
And you've got depreciation, recapture, and all that stuff, and then it, capital gains, and it's not fun anymore.
Exactly. Yeah. Yeah. So you got to exchange into like property, right? Ideally. Yeah. So okay. So last question. So what? I'm kind of a spiritual guy, and I meditate every day generally, and I have kind of my morning routine, and I am curious with my guests, like what role does that play in your world? Maybe whether it's spiritual or not, kind of a daily sort of routine or habits that are important to you and to in particular to your mindset for success.
That's a good question. So one of my life goals was to never set an alarm clock. That was before I had kids. So I would sleep in till 7:30 because I had the mindset that, when I get my 8-9 hours, I'm a 9 hours of sleep person. I'm not tired. I'm fully mentally focused. I'm ready to take on the day. Now I said I've got a toddler. So, 6:30 is when I'm up. But really like our mornings are like kind of just quiet, chill time. Everyone, my husband gets up, my baby gets up, I get up. We all kind of do what we need to do in our mornings to get set. One of my big things is working out. So I do that every other day. No one can get a hold of me for an entire hour. My phone is in the car. It's great. And that helps me really like reset and set my day. but I live and die off to-do list and priorities.
Mm.
So every morning, one of the first things I do is I read through all my emails from yesterday. I add anything that I need to do on my to-do list, and then I prioritize out my day. And that's what I really, and then said, some days I wake up feeling, those days you wake up and you just don't feel like it.
Mm-hmm.
We had one last week where it's like, it's a cold, rainy day. I'm going to sit in my pajamas all day. I'm going to move all my meetings and I want to eat pizza. That's what I wanted to do for my day. But some days I wake up and I'm super productive. And those days I just knock through everything that I got. So really said there's no routine or anything, but I do follow a diligent to-do list every single day.
You've really mastered, you kind of seem to have an art to your life almost, where you have your priorities, you know what they are. You know that it's not all about work for you at all. Like 30 hours a week is plenty. It's enough. And you've made it, you've engineered it so that it's enough to have the level of success that you want to have, that you're committed to having. And you've got this thing where you can chuck it for the day and eat pizza in your pajamas or go to Macedonia or Serbia for 6 weeks at a time, or
my
whatever.
husband is from Serbia, so we go there for at least a month,
There you go.
So that's a family in-law type trip that we, don't have to go to, but it's a requirement. But I popped a bottle of Prosecco at like at 3:00 in the afternoon because I felt like it, like, let's just have some bubbly, like, why not? The day's over. But it's said when, it's important, right? It said, watching my dad not get to have the lifestyle that he wanted, it absolutely impacted and completely turned around my life. And that's something that I think about quite often. Why am I doing all of this? Right? If I'm doing all this to see my kid for an hour a day, like, that's not why I'm doing this. So how can I readjust things and reprioritize things so that we can take her to the park in the afternoon because we want to? It's a nice day. Let's take her to the park. We have a lot more flexible time. My husband stays home with our kid because I have enough success in our business so that we went to the aquarium last week on a Tuesday because we felt like it. Like, we spend a lot of time together as a family, and block off a lot of time where I turn my phone off and just don't answer calls for 3 hours because we're having family time.
Love it. I love it. And I love how you took a loss and, a really big loss in your life, and the grief around it and the lessons learned from the life that your dad lived, and the things that he taught you, and made that a real central part of your mindset now, and kind of in your mindset really since then. All the things that you've done in your business have really all happened since that point of time.
Absolutely. 100%.
Yeah. I mean,
I would have been still working
remarkable.
corporate,
Yeah, that's amazing.
I would have, it was never even a glimmer on my mind to be self-employed or to go into real estate before that. Yeah.
Oh, that's great. Good for you. And just way to take a really tough life event and use it to transform, your reality and and really create a lot of freedom in your life. And, for the listener, like, that's what this show is about. Like, it's about this kind of story. It's about the freedom that real estate investing can provide, the financial freedom of particularly buy and hold strategies, and passive cash flow. What that can provide for you is there's just so many levels of benefit, from passive cash flow to wealth building, appreciation, to tax advantages. We talk risk mitigation. We talk about this a lot, and all the different advantages to real estate and to multifamily in particular. And
there's a lot of aspects too. I mean, you can do note investing, you can do mobile home parks.
Yeah.
There's a
storage
lot.
Units.
Yeah. Self-storage is huge. So it doesn't have to be as hands-on as I do it.
Right.
Or I did it, but there's a million ways you can get involved.
Yeah.
Passively or aggressively, whatever way you want.
Yeah. Yeah. Exactly. Bree, so for listeners to reach you, what's the best way to reach out to you?
You can reach me. I'm on Bigger Pockets a lot. I'm a moderator for Bigger Pockets, so I'm there almost every single day.
Hmm.
Or my website, which is secondcity-re.com.
So Brianna Schmidt at Bigger Pockets is going to be a good place to find you.
Yeah, Bree Schmidt on Bigger Pockets.
Bree Schmidt. Okay. So BRIE for the listeners, Bree Schmidt on Bigger Pockets. Or and just say your website domain one more time.
Yeah, Second City spelled out -re.com.
Okay, there you go. Perfect. Well, this has been, I'm inspired. I've had my my dose of weekly inspiration here, Bree. This has been great. I think your story really highlights that there's a lot of ways to skin the cat, in this business. There really are. And there's all of those ways can lead to financial freedom and to lifestyle by design, which you've mastered. And so I can tell that you really have a life that you love to live, and that's what it's all about, isn't it?
Yeah, it is.
Yeah,
it's not boring, that's for sure.
That's not boring. Yeah, it's not boring. Well, on that, listeners, I hope you've gotten some inspiration out of Bree's story too. And please reach out to Bree if you'd like to follow up with her on anything. And always you can always reach out to me as well. And thank you for listening to another episode of The Apartment Guys, and we'll see you on the next one.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.